planned out to teach people to how to go from trading stocks, kind of very, very basic, to understanding the complex strategies and opportunities that you have with trading options. And so before we even begin about the details about this lesson, let's just break down the title because it is actually very jam-packed with information to teach people to how to go from trading. 1 second. There you go. Okay, so long, short, vertical option spreads, or credit and debit spreads. And so long and short, you should understand that is buy or sell. And then vertical means that the options that you buy or sell together have the same expiration date. So you can actually technically buy different expirations for your option spreads. I'm not very familiar with this concept, and I don't trade it ever. So I may trade it in the future, and if I do, then I'll teach you guys. But right now, I never touch that. So vertical just means that they have the same expiration. Options, obviously, you know what that is. And spread means buying or selling a pair, buying and selling a pair of puts or calls together. So if you pay money, then it's a debit spread, and if you collect money, then it's a credit spread. Okay, so I should have posted this on my Instagram. I'll post it later. But today's has 6 kind of main slides. We'll talk about 5 ways to support the channel, but we're gonna walk through how you do credit and debit spreads with real live examples like the SPY. Then we'll talk about how do you find the best option spreads to trade, and I actually updated the master file with a new tool to do this. And so if you haven't, go download the latest version of the master file. I just updated it today. Then we'll talk about the pros and cons of naked options versus spreads, and then risk management for option spreads trading, and lastly, post lesson actions. And we actually have a cheat sheet and an appendix this time. This will be mainly for preparing for the next lesson, which will be multi-leg strategies. But right now, we're just going to be talking about credit or debit spreads, which is just a pair of calls or puts. Great. So as always, the 5 ways to support the channel. Number 1 is like, comment, and subscribe, completely free, or you can share with others that also might find this content useful. We have Amazon affiliate links in the description below. Like I said, you don't have to buy the product that it directly links you to. If you buy anything after going through my link, the channel benefits from that. There's also referral links for Webull and Robinhood in the description, and donation or tips link, which is never required but always appreciated. As always, the disclaimer: remember, everything said on my videos is just my opinion based on my experience trading and is for educational purposes only. Trading is very risky. Nothing I say is advice or recommendation. Read the description and please trade at your own risk. Awesome. So this should look very familiar to you guys, which is the P&L or profit and loss charts for options. We're going to go through spreads now instead of just naked options, and which is why you see a 1 + 2 = 3. So let's go through a live example here. Open up Robinhood. You know what? We could have used. Let's use this actually. Let's use Thinkorswim. Thinkorswim. Sorry, excuse the pause here. Okay. So Thinkorswim is pulling up, and then we'll go through a example of a debit spread with the SPY, and then an example of a credit spread with the SPY. And then after that, we'll go into how to find the best type of debit or best type of credit spread that you can trade. And really, there's infinite possibilities. I mean, there's so many options, contracts that you can buy or sell, and so you have a lot of flexibility in terms of how you want to trade, which I love about options. Okay, so let's go to the SPY here and go through a few live examples. Oh, 1 second. All right, awesome. So let's just use a near-term example, and we're just going to go to 10 because we don't need that many. And we'll focus on kind of near the or at the money options for now. So let's do a longer expiration, 45 days. So let's just do like the end of June. Okay, awesome. So here is the bid, here's the ask, open interest and volume. I'm actually going to change it to mark because that's what we're going to use, which is kind of the midpoint between the bid and the ask. Or you can use the ask, it's up to you. It's easier to fill your contracts if you use use the ask. It's a little harder to fill your contracts, especially you have to keep in mind that you're now not just buying one option, right? You're trying to buy a pair of options together, or buy or sell together at the same time. So it's a little bit less liquid, and so it's a little bit harder for your orders to be filled. Just keep that in mind. And I'll talk about the pros and cons of naked options versus spreads later in the lesson. But just keep that in mind going forward if you do want to try out credit and debit spreads, which I do highly recommend. And we'll talk about that why later. So let's just do a debit spread first. And to keep it simple, I'll just do calls for now. Call credit spread and call debit spread. So let's do a call credit spread. And we're going to do, it's currently trading about 304, 305-ish. So let's just do 304, and then let's assume it's 304 about. We'll go to down 4 and up 4. So 3, 1, 2, 3, 4, and 1, 2, 3, 4. So 300 and 308. And we'll buy a 300 call and sell a 308 call. And so when you do a debit spread, what you do is you buy a more in the money option and you sell a more out of the money option. And why do you want to do that? Essentially, what you do with spreads, not just debit or credit, is you're limiting the risk for your trade, right? But you're also limiting your upside. So if you sold a naked option, if you remember from our last lesson, technically you have unlimited risk, right? Because the stock price can go in any direction except down to zero. But it's still basically unlimited risk. But if you sell or buy a certain option, you cap your risk. It essentially acts as if a covered call or a covered put, which we talked about in the last lesson. So this is 11.25 and this is 6.15. So 11.25 and 6.15. So let me just write a note here. 11.25. I'll just use my little pen here. 11.25 and 6.15. And this is for the 300 and the 308. Sorry if it blocks the text. So let's draw the profit and loss charts here. And so, as always, determine the amount of money you collect or pay. And so you're paying 11.25 here for a 300 call. And it's currently at 304. And so until your strike price, you gain no money, right? And then as soon as your strike price is hit, you will begin to gain and make money if you're buying a call. And so we're buying a call here, long, and we're shorting the 308 right here. And so after that, you mark the amount of money you're collecting, mark the profit or loss on the Y chart, y-axis, and then mark the strike price on the x-axis, and then mark the break-even price, which is 300 plus 11.25, which is 311.25. And so we'll break even here. It's a pretty bad break even, right? It's kind of far from 304, which is the current price, but after that we get unlimited profit, right? And so here is another one which we're actually shorting, and so we're going to collect this 615, 615, and the current price, mark the profit or loss, mark the strike, which is 308, and 304 is the current price, and then 308 minus 615 is I can't even do that in my head. 308 minus 615 is 301.85. So we do a 301.85, and so we collect 615 until we go to 301.85, and then at that point we have unlimited downside, right? Because if it goes to zero, then we have to pay them like, what is that? A lot of money. 30,000 about. I believe 300. Let me just do that. 300 times 100, $30,000 per contract. Keep that in mind. Okay, so now you're longing a call and you're shorting a call. So what you do now is you put them together. And so since I'm buying it more in the money and selling it more out of the money, this will be a debit. You have to be very comfortable with that idea. But essentially, if you're buying it more in the money and you're selling it more out of the money, that's a debit spread. If you're selling more in the money, and you're buying a more out of the money, that is a credit spread. And you have to be very familiar with in the money and out of the money and what that means, and which is why this lesson is lesson 7, and that's why there are 6 lessons before this. So make sure you go watch the other lessons if that's not familiar to you. And so because we're buying a more in the money, this is a debit spread, and so that automatically tells you that you're going to pay money, right? Because it's debit. A credit spread you will collect. And so a very simple way to do a debit spread is simply you take 11.25 and you subtract the 6.25, right? Because you're collecting the 6.15 for the 3.08, and so you're paying a total of 5.10. And you'll always do this when you do debit spreads and credit spreads. And so you're paying a total of 5.10, and what happens now is you cap your upside, but you're paying less than half of what you originally paid. And so you still have the 300. Now the 3.08 acts as a maximum profit, right? And the 3.04 is right in the middle, okay? And so you are going to pay 5.1, and so your break even is technically 305.1. And so you don't make any money until you hit your strike price. Then you break even at 305.1, and then your maximum profit is 308. And after that, you make no more money because you actually have a short here and a long here. So that's how a debit spread works. Hopefully that makes sense. If you have any questions, as always, you can always ask your questions at any time during the lesson, and I will answer them when I get a chance. And so, okay, so here's your max credit. How much your maximum going to lose, what's the maximum you're going to make. And the maximum you're going to make is quite simply the space between here, which is the break-even point, 305.1, and 308. So you do the math, 308 minus 305.1, and that is $290. And you're like, wow, that doesn't seem like a very good deal. Well, remember, you can always adjust which contracts you're buying. So and that's the beautiful thing about options trading, is that you are able to pick and choose which option contracts you want to buy. And so you have a lot of flexibility, and like, okay, I don't really like this deal, this seems like a terrible deal, I'm only making $290 max, but I'm risking 510. And so 290 can't do it, 290 divided by 510, that is a 56% gain. Now you also have to remember that that it's actually pretty good. I remember in trading, you're really just trying to get 6-10% gains on your total account over time, and 56% is actually a really good return. But what I don't like about this is that even though you did a debit spread, your break even is still out like above where the current stock price is. So I don't love that, especially if you're gonna do what they call straddling the current price, which is one in the money and one out of the money. You can also do debit spreads very far out above the strike price or the current stock price, or below the stock price. Remember, you have the flexibility to buy contracts anywhere. So I like to generally actually just buy out of the money. It's a little riskier. Like I said, my risk tolerance is a little higher than most, but it's up to you. And you can even buy more in the money. And so let's do an example of that. Let's adjust this now. So we'll keep the 300, and we don't like the 308 because the break even is above the current stock price. And so we're just going to buy sell a more in the money option, okay? Because this is 308. We don't like that. It's the break even is still above the stock price. So we can just simply go here and let's just do a 306. So we're shorting a call contract $2 above the strike the current price, and we're buying a call contract $4 below the current stock price. So this one is 306 at 720. 306.7. Okay, let's just do this. Actually, let's just do a 304, and let's see what. But that's kind of ugly. All right, yeah, we'll do a 306. And that is $7.30. Okay, so $7.30, and so 11.25 minus $7.30, and that is $3.95, and this is 306. And so this is what you'll do. And remember, I updated the master file, and we'll play with this a little bit with the master file with an Excel tool, which makes all this a lot easier, except going through the charts and all that. But you have to understand the idea and the understanding behind why it works before we can do the tool, because that's way more important. Otherwise, you're just blindly using a tool. And so 395, and I'm not even going to do the 306 because it's irrelevant. It's all about what happens after you buy and short two different contracts. What is the result? That's what we care about anyways. And so right now we have a 300 call that we bought and a 306 short call that we shorted, and the current price is 304. So we're paying 395 for this debit spread. We're doing spread is two contracts together. And so our break even now is beautiful. And now it's actually below the current stock price, which is at 303.95. We pay less money even than our original example. So we're risking even less capital, which is even better. And so until 300, we don't make any money. At 300, we start to make money. We break even at 303.95. And then we hit 306, which is our max profit because we shorted a call contract there. And then we just make that amount of money maximum. So 306 minus 303.95 is 202.05. And so this is a debit spread. Hopefully with these two examples that helps you clear it up. And then divide 205 divided by 3.95, and you have a much lower return on capital. Remember the last one with the 308, we got a 56% return on our capital versus this is only a 52% return on capital. And that should make sense, right? Because this is a safer spread because we have a better break even. And that is the beautiful thing about options trading is we're playing with how much risk we're comfortable taking on. And in trading, it's generally low risk, low return, and high risk, high return. Risk and return should be correlated, essentially. And so we have a better break even, but a lower return on capital maximum. But I think I still like this better than the last trade because my break even is lower than the current stock price. So it can actually lose 5 cents and I still break even versus the other one. I actually had the stock price had to go up by $1.10 before I could break even. All right, so let's now do credit spread. And so a credit spread is the exact opposite of this. And generally you're not going to straddle the current stock price with a credit spread. Why? Because, well, you're making it so that your chance of losing money is pretty high. And the beautiful thing about credit spreads is that you can go and sell a very out of the money credit spread and have a really high chance of success. And so let's just do that instead. And so let's extend this a little bit more to 14. And instead of buying a straddled spread, which you do with debit spreads if you want a high chance of success, we're going to sell it out of the money credit spread to increase our chance of success with our credit spread. So let's do a 308 and a 310 credit spread. So 615 and we'll just say 515 to make it easier. And so 615 for 308 and 515 for 310. And so now, since we know it's a credit spread because we're selling this one and we're buying this one, we're going to simply, I'll show it real quick actually. So 304 is the current stock price. We are selling the 308, which I showed last time. So I'm not going to do all the math essentially. So you collect 615 and you break even here and it just goes infinite. I forgot the number. And then a 310 call, which you would usually not want to buy a 310 call because you want this. Yeah, the stock price has to go up a lot before the 310 call is in the money. But since we're using it to cap our risk in this case for the credit spread, it's actually a beautiful thing that is very out of the money. And so if we're paying 515 for a 310 call, we don't even break even if we bought this as a naked option, call option, till 315. Wow, that number makes it complicated, but 315.15, right? So we paid 515 here. It goes all the way here till 310, and then we start making money, break even at 315.15, and then we have unlimited upside. But since we're doing a credit spread, We sold this one and we bought this one to limit our risk to the $2 difference between 308 and 310. We now have a beautiful scenario where it's 304, right? We collected $1, and so until 308, oh, sorry about that. Until 308, we don't even lose any money that we collect. And then, since it's $1, the break even is at 309, and the max risk that we lose is at $10. And so it goes here down, and then the max risk is $1. So this is actually an amazing trade in my opinion, and I may even consider doing this in when the market opens. But you get a 50-50 chance of success to risk. Remember, we're collecting it, and return on capital, 1-to-1 risk return. And the current stock price is at 304. Actually, I wouldn't do this because, well, this is a June. Remember, time is also a factor in options, and this is a June 30th expiration. So technically, this is 30 days for the current SPY price to rise above 308. But this is the beautiful thing about credit spreads. This stock has to rise $5 before you even break even. And until it rises $5, you get to keep the dollar that you made. That's right. And so I'm just going to do that one example for the credit spread, but hopefully that can show you how beautiful credit spreads are. And credit spreads are one of the safest trading methods in existence, and that is why a lot of Wall Street traders use credit spreads instead of just buying stocks or selling stocks when they're investing, because it's just like you said. Look what it shows. You can be wrong, right? You're selling a 308, 310 credit spread, and you're saying that the stock price will stay below 308, 310 call credit spread. And so you're saying the stock price will stay below 308, and the current stock price is only 304. And so you have $4 before you even start losing money, and a whole dollar more because you collected $1 until you break even. And so that is the beautiful thing about trading options. Now, how do you find the best option to trade? So you go through the options tab in the master file using SPY as an example. File has been updated again, so please download latest file. There's almost no such thing as a bad deal in options, right? Because if you look at the credit or the debit spread and you're like, wow, that's a really bad deal, well, then you can just do the opposite and take the opposite side if you want to. Not to say you will always do that just because you don't want to buy an option, you're going to sell it, but you have the choice, and that's what's amazing. And then snaking the chain, remember, just start at a low limit price if you're buying, or try to sell at as high of a price as you can if you're collecting a credit. And then slowly move your limit price down towards the worst direction until you are filled. Don't just start in the middle. You may be surprised how many times, especially when you're doing spreads, because you're buying and selling two options at the same time, you can get filled at a really, really nice price. And so always snake the chain when you buy options. Even when you buy naked or spreads, always, always, always. And sometimes I even buy one leg of the option of the spread at a time. And so I'll buy the spread and then I'll sell the other end, or sell first, or, well, you can't sell first. So you always buy first and then you can sell the other side later. So that's also an option. You don't always have to do spreads together. All right, so let's use the master file now. Let's bring that up. Traders and PJs, files. Okay, perfect. Okay, so I built this new tool here. It's on this right hand side. I gave you some notes to keep in mind. You want to collect a high credit for credit spreads and low for debit spreads, or pay a low amount for a debit spread. And if you want to have a low amount of net risk for a credit spread, but a high amount of potential profitability for a debit spread. And that's what these notes mean. And so we're not going to do this many examples. What is this? 1, 2, 3. Oh, well, we can just do that. Count 8. We're not going to do 8 examples. And this is the beautiful thing about this tool. You don't have to use all 8 strike 2s for your analysis. You can simply just do like 1. Or in this case, we can do 2. And so we're going to do debit spread and the credit spread. Okay. June 30th was our expiration. You don't actually even have to update the expiration. I just like to do it because then I can keep in mind what I was analyzing the last time I was looking at this tool and my analysis. And so we bought a 300 strike, and then this is a credit spread, and we were selling a 308 credit spread. And so we're expecting in the credit spread scenario, we were expecting it to stay below 308, and then in the debit spread, we're expecting it to stay above 300. So let's do the debit spread first, and we'll just do the two examples that we did in the previous slide. And so what is the credit I collected? 300 is 1126, but you have to multiply by 100. See, ask or mark times 100. And so I'll just do 1125 to make it easier. And the 308 was 615 credit received or paid, right? Depending on whatever side you want to do, if you're longing or shorting. If you're longing, obviously you're paying money. If you're shorting, you're collecting money. So we're just going to do 2 strikes here as our example. And this is how fast that whole analysis we did in the last slide can be done with this tool. And so we just quickly go to the mark here, 306, and we see it at 730. So we just do 730. And then we quickly go here at 308, 615. And we can even do 10. Let's just do the $10 one for fun. 511, 510, right? So let's see. Oh, well, that doesn't make sense. Oh, sorry. This needs to be updated. That's why. Okay, so the total total profit that we can make if you didn't have to pay any money, which we do because it's a debit spread, is 600, 800, or 1,000, right? It's just the difference between our first strike and the strike we sell. So we bought a 300 since it's a debit spread, and we sold a 306. So the max profit is technically 600, but since we paid the difference between the mark prices, we paid 395. We can only collect the max profit minus the amount we paid, and that is 205. And so you can see here, right here, you can see what amount of return on capital we have. So remember, we did the math earlier: 52.52 or 52% return on capital, 57% return on capital, and 63% return on capital. Now you may look at this and be like, wow, this is so great. This is the highest return on capital. Let's just buy this one. But remember, oh, maybe I should add a break-even analysis here, and I actually will. So hold off on downloading. But essentially, I'm gonna show the break-even, and the break-even should be straightforward. Shift cells down. And this simply the strike price plus the amount you paid divided by 100, and then you just pull that to the right, and that is your break even. And so you can't just look at the return on capital. You also have to look at your break even price, break even point price. Yep. Okay. Sorry, I'm doing this all live. But you look at the break-even price, and you can see, like, if the current stock price is 304, well, the best break-even is this, 303.95, versus if you bought a 310 debit spread, the break-even is 306.15, which is quite high, in my opinion. All right, so let's do the 308 real quick. So 308, we have a 615 collection, and then we go do a 310, 312, and 314. And then I'll add the break-even point here, right? Oh, shoot. There you go. Good. And so 310, we look at the amount of the mark here, 310, and actually I'm going to just make it all so we can go see the 310, 312, and 314. 310 is 510. Oh, oops, 510. 312 is 418. Just do the exact 418. Oh, 418. And 314 is 3.36, so 336. And so here's the total risk you're taking on. So and remember, we're in a credit spread, there's a risk potential versus a debit spread, you have a potential of profit. And so you collect money at the beginning, and then you have a potential to lose money if the trade moves against you or goes in the wrong direction that you didn't expect. And so here's the total risk, which is the difference between, again, the strike prices, 200, 400, 600. And in Robinhood, this is called, what is it called again? Buying power. Will take out from your account this much buying power if you sell a credit spread. And so just because you collected money, well, then how much money do you no longer are allowed to trade? It's basically the total amount of risk that trade has. And so if you do a 308, 310 credit spread, they're going to take away $200 from your account just in case you lose and you're wrong and you lose the max amount from the position. And so you can see here, you collect $105, $197, and $279. Your break-even price is $309, $310, $310.8. And this is the net risk, and this is what you care about, right? Because you collected money. Well, if you already collected money and the most you can lose is $200, well, the difference is then your net risk of the position. And so you want this to be low for credit and high for debit. And so this is the best, actually, 310, 308, versus you collect $279, but you can actually potentially lose $321 if you're wrong and the stock price goes $10 up and past 314, right? And so this is the beautiful thing. Obviously, you have a better break-even point because you're collecting more money with 314, and so you have to do your own analysis and come up with your own, your own opinion on which one is the best, right? It's really just based on your personal preference. Do you want to collect more money but have a potential to lose more money if you're very, very wrong, but you have a better break-even at the beginning, or do you want to collect a little bit less money, have a little bit worse break even, but you lose potentially less money if you're wrong in the trade? Okay, and so this is the beautiful thing about this tool. Let me go, I'll go update this after this lesson, and that's it. That's credit and debit spreads. It's not super complicated. Essentially, you're buying or selling another option in order to limit your risk or limit your upside. Okay, so what are the pros and cons versus naked options versus spreads? So spreads is essentially what you're doing is you're trading off your really, really high upside, not unlimited. If you're shorting an option, obviously you don't have unlimited upside, but it's a much larger upside because you're not buying another option or paying money to protect yourself. But what you do with spreads versus naked options is you're trading the higher upside for higher trade-off between for higher probability of profit. Because you have less risk, you have a higher chance of making money. All right, so let's do the pros and cons. I'll just quickly walk through them. So if you do a naked option, then obviously you have a large credit when you short versus having to pay money to buy a credit to limit your risk. But it's not worth the unlimited risk, right? One bad trade can end your entire trading portfolio with short naked options. So I highly recommend doing credit spreads instead of shorting naked options. It's just much safer, in my opinion. And remember, the most important thing about trading is staying alive. Naked options, what is nice is that they're more liquid. You only have to buy one thing versus two things at the same time. So it's easier to fill and execute. There's unlimited upside, but it's not worth the risk and the worst break even, in my opinion. Remember, like if you bought the 300 and you paid 11.25, your break even is 311.25, versus if you buy a 300 and sell a 306 option, the break even was even below the current stock price. And that is the beautiful thing about spreads, right? So I don't think the higher upside is worth the higher risk and worse break even. Also, naked options have higher costs. You have to pay more at the beginning for buying a naked option. Worse break even, as I mentioned before. Unlimited risk when shorting options, and long naked options are depreciating assets. Remember, theta is still a factor, and so naked options are depreciating assets. And so if you don't have, by doing a spread, you actually reduce theta decay by a lot, and it's a beautiful thing. Obviously, that works against you when you do a credit spread versus shorting a naked option. But as I said, it's not worth the unlimited risk, in my opinion, in order to have the higher credit that you get and get the higher theta decay. I don't think it's worth the higher theta decay and the higher credit. And on the credit and debit spread, credit/debit spread pros and cons is basically the opposite of the naked options, right? So let's move on. Okay. So the beautiful thing about trading options instead of stocks is allowing us to control, as the trader, how much risk we are comfortable taking. And hopefully that the example that I showed with managing your break-even point and controlling how where your break-even point is, how much you're paying, and how much your maximum potential profit is, shows the power of options, and especially option spreads, right? Now you have the ability to take how much risk you're comfortable taking. I think that's awesome and really interesting. Oh, sorry. Can you close the door? I'm actually live streaming. And then, for example, if you want to be very safe, you can always just buy a very in-the-money option. Or if you want to be very safe with selling options, you can just sell a very out of the money option. And I talk about this here. Check delta. Delta basically means the probability of profit, which we talked about here. Probability of profit for the option that you're buying. So here, if we look at delta here, Greeks delta. And so the delta here for the 300, because it's already in the money, is 50. I can't believe it's updating right now. Oh yeah, future markets are open. I forgot it's Sunday. So this is 58% chance of profit versus the 310 has 38% chance of profit. And so keep that in mind. And so you are able to control what your probability of profit is by depending on the option you buy. And so if you wanted to be very safe, you could sell like a $3.95 option and collect $15. No, wait, $1.05. But the probability of profit is apparently 0% theoretically, based on the calculations. That's probably not a great example, but let's say you sell like a 332. You have a 5% chance of losing money because you're selling, remember, and you collect $33. So it's very safe. You collect a very little bit amount of money compared to the more closer to the money options, but it's very safe, right, because you're selling. And you're able to control the amount of risk you want to take. You can read this, but risk management, there's so many things you can do to control your risk, especially just choosing the right options contracts for how much risk you're willing to take is the first step. Another things you can do, though, is keep your positions to 2%. Importance of timing when you buy them, because stock prices move and the option prices will move along with the stock price. So you may want to even wait a few months. And sometimes timing is very important. Just because you have an idea for a trade, it may be better to buy that option spread in a month from now than now. And so you have to kind of make that own decision yourself. Always buy more time if you're longing options. So that even if you're wrong, you still have like a percentage of your original investment rather than just losing 100% when you're wrong at that expiration. And if possible, try to make your place free when you make 100% returns, which is possible for options, as you probably have noticed already. For shorting options, always have a good trade plan. Don't just short options for no reason. For example, Avis Budget Group, I shorted an August option, shorted a credit spread by August expiration because I know that they're going to have earnings before my credit spread expires, and that allows me to have a catalyst in order to increase the probability of profit or probability of success for my trade. And VTIQ, the reason I bought a January 2021 expiration, even though it's a long time to make 30-40% returns, is because I wanted to have the 180-day lockup period expire before my option contracts expire. So you have to be very careful about having a good trade plan, have a catalyst, have a hypothesis, and trade around your expirations around those catalysts, especially for credit spreads. You can also do this, and both of these apply both ways, right? You can apply some of these lessons to shorting or longing, just depending on the lesson. Make sure you have a good margin of safety. I've talked about this just now, but you can sell a very out of the money option to be very safe if you want to. It's all based on how comfortable you are with risk. Like for a car, I probably should have had more margin of safety because, as you know, in my investing video, I did a credit spread of $22 was my strike price for my credit spread, which means after $22 for my credit spread, I'm going to start losing money, and the current price is like $21. So I probably should have maybe sold at $25 just to give myself like $5 of safety versus just $2 of safety. When I shorted it, it was about $20. Actually, it was at 18, which is kind of the crazier part. Which is why I felt comfortable with 22, but now it's at 21. So I'm still going to hold. I still feel very comfortable with my trade plan, but it's not as safe as my original investment. So it's not great for me, but I'm still going to hold my car position. And VTIQ, that was a terrible margin of safety. I have it $22.50, $25 credit spread on that, and it's currently trading at like $29. But I just feel very comfortable with my fundamental analysis. If you want to understand that, go watch my Twitter. I have a few tweets on VTIQ that you can read or watch based on what you do. I have videos and articles that I read and watched. Okay, so that is about good margin of safety. And one of the things that Warren Buffett always talks about is margin of safety in investments because it's a very crucial concept. All right, so that is it for today's lesson. Please, these are complicated concepts. Please go watch Tasty Trade's videos. They're completely free, both on their YouTube and as well on their website. Just take advantage of the free resources in this world. Now with Google existing, there's just so much free resources. So that is why I'm not a big supporter of buying courses, but you can do what you will. Go paper trade before you do things that you're not very comfortable with, before you do it with real money. And always have a trade plan, whether you're doing a debit or credit spread. And feel free to comment below if you have certain trades that you want other viewers and myself to provide thoughts on. I reply to every comment, especially now, while I still have a low subscriber base. Okay, and comment below if you have anything you want me to cover in future lessons or have questions from this lesson. Let me know if you have any questions. I'm going to stay on for a couple more minutes before hopping off, and I'll show you kind of the appendix here. These are the multi-leg option strategies, not just two. Credit and debit spreads are multi-leg because you're doing two options together, but these are four options together. These three are four options together, and maybe I'll add a column here to the right, number of options in strategy, and there's 2, 2, 4, 4, 4. Okay, and lastly, I'm just gonna leave it on the screen for a little bit. Great lesson, but still catching up, but wanted to watch live. Thank you very much, Eric. Appreciate the support, man. Love you, brother. And other option strategies, you guys can look at here. I'm just gonna leave it on the screen so you can pause it and look at it if you like. But unless anyone has any questions, I'm gonna be hopping off very shortly. I'll stay on for another minute or so. Close this. I need to work on my sitting posture. I'm always having such bad sitting form when I record, because I'm so focused on what I'm trying to say and instead of focusing on how I'm sitting. All right, looks like nobody has any questions, so thank you guys as always for watching, and hopefully this added a lot of value to your trading knowledge, and hope to see you guys at the next video.